Here we go. This is the last FOMC of 2025, and I'll be the first to say it. Let's get rid of this year. I'm done with this year. Let's move into 2026. I appreciate you for tuning in. This is the home of the FOMC. We invented the FOMC stream here, and I know you have a choice in watching it now. Every mainstream media channel, pretty much every YouTube channel that does markets covers it. We made a dent. We made a dent in the world. It's part of our legacy, and each and every one of you that watches and tunes in month over month to these keeps it alive, baby. So I appreciate you all being here. You rock. Please hit the like button, subscribe, follow, whatever it is, whatever platform you're on, especially over on youtube.com/TOMPOW. Join us over there. We're going to have thousands of live viewers today. It's going to be a wild time. We're going to do our best to break down the Fed, what Chair Powell's talking about, the implications, what's likely to come during this meeting, what we're going to be looking for specifically, and we're going to try to have a good time. These meetings tend to be really dry, and we try to make them just a little bit more manageable. So welcome back. Settle in, buckle up. Grab your brews, roll up, whatever you're doing today on this fine Thursday. You are welcomed. Let's go over the schedule first. After you've hit like and subscribe, help us engage the algo. Let's go over the schedule. It is 1:30. We're live a little bit early so that we can get all the people here. We can kind of discuss, maybe just chat about it, figure out what we think, kind of spread rumors a little bit early. And at 2 p.m., so in just about 30 minutes, the interest rate decision will be published live, and we will scramble to find it first. At 2:30, so 30 minutes after that, Chair Powell will speak live. He'll speak for about 10 minutes, and then they typically do anywhere from 40 minutes to like an hour of Q&A. And that is the juicy part. The Q&A and really his keynote are where the goodies. That's where we get all the good stuff. So we have a little bit of time from then, and we're going to warm it up in the best way. In front of us, we have our typical FOMC chart. We have Bitcoin, the dollar, and the S&P right in front of us here. You can see the current line has been crossed, and that is because we went live. Coming up, we see the interest rate decision at 2 and Powell speaking at 2:30. So as price moves over to these, that will be in real time when these things happen. Keep an eye. I'll start with this warning as well. I really don't encourage trading during the FOMC, guys. We are a trading channel. We have a trading partner, BYDFi. They're great. You can sign up, use them, no KYC. But during these events, price can get very volatile, and we even tend to see a pretty predictable pattern during and into these events that usually leaves leveraged positions wrecked in either direction. So to just cover it, to give you a visual here, oftentimes we will see Bitcoin trending in a direction into the rate decision. So for now, let's just say that's up. Once the decision comes in, whether it's what we expected, whether it's good, whether it's bad, we tend to see price reverse again. Ooh, speaking of which, Bitcoin making a little move right here. 92.6. We tend to see it reverse again, and then into Powell speaking one more time. So what happens is longs typically get wrecked, shorts typically get wrecked, and by the end of it, we're usually right about where we were to begin with. So please, I give you caution. Please don't feel like you have to be in trade. Don't pressure yourself. It is not necessary. Oftentimes, I like to wait for the market to kind of stabilize and then look for some kind of entry afterwards, but we'll skip that for now. We will do a little analysis and a little trading talk, but first let's get into a little bit, Bitcoin's distracting me. Let's get into kind of what we're looking for here today. I think that's a good way to do it. Expectations today are high. This is really, maybe doesn't even need to be said, but for anybody tuning in, they are very high. The market and everyone else is expecting a 25 basis point cut. There are posts everywhere about 50 BPS, maybe even higher. We really let this kind of get away from us over the last year. These FOMC meetings, the speculation has gotten, I don't even know if you want to call it speculation, but just blatantly false news, clickbaiting, like Jerome Powell stepping down every week, or he's being fired like every single meeting. It's gotten out of hand. It's a little crazy, but we're seeing all kinds of expectations be built up. As it stands, if we look at, say, the Fed rate tool monitor, we have 33 minutes, and this is giving us 85%, it's saying 85% chance of a 25 BPS cut. Oh, yeah, current probability 85. Up from 83, but down from 86. No cut. It still stands at 15%, which is larger than I'm sure people are comfortable with. If you are looking or betting on this cut happening, 15% is really not a comfortable place to be. By all means, if the market does not get a 25 BPS cut, there's going to be fallout. There's going to be some chaos. Markets thrive on predictability and consistency. They expect something, and if they don't get it, things typically go bad. Weirdly, if they do get it, that doesn't mean things go well, and that is maybe why markets have felt so irrational lately. But a 25 cut would bring the federal funds rate down to 3.5 to 3.75. This would mark the third cut since the Fed began easing in September of 2024. So that would be 75 BPS cuts since September. We have the dot plot from the last FOMC. We'll get an update. We're definitely going to be watching this closely. We'll get an update during the FOMC today. The dot plot dispels all rumors. Actually, this one's from September, but close enough. It dispels all rumors. This is what the Fed members are thinking. This is how they see the future of the Fed funds rate going into the end of the year, 25, into next year, 26, into 27, 28, and then what they call the long term. The Fed's goal is to get the Fed funds rate, I would say, to the neutral rate, basically to where to the neutral rate, and to keep it while balancing inflation and unemployment. And at this point, it probably sits somewhere around 3%. Now, we don't see Fed members betting, at least in the September and October meetings, on interest rates really going that much lower, which means the Fed is likely in agreement with me, thinking that the neutral rate is around 3%. We can see all the way out to 2027, there's actually only one member that will be looking for a total of 150 cut from now until 2027. Only one member. The median sitting at 3.25 to 3%. That speaks volumes. Now, this can update. This can be different. Today, we can see maybe a little more hawkish stance. We can see some of those votes moving down. Each one of these dots represents one member. You'll notice Chair Powell is not like a special dot. He isn't a big dot. He isn't two dots. He's one dot. That may change today, and that's probably likely. In fact, I will maybe ease your tensions here by saying it is not guaranteed, but it is incredibly likely that we get a 25 BPS cut today. At the last meeting, the Fed was discussing their balance sheet, the magical words we've been looking for, the quantitative easing, the quantitative tightening. Essentially what that is the Fed injecting or removing liquidity from markets by buying and selling, putting money out, bringing money in. At the last meeting, they announced that they would end quantitative tightening, meaning removing the liquidity from markets, that they would cease with that practice December 1st. Now, we can monitor this. Unfortunately, it's not in real time, unfortunately, but it is somewhat in real time. Let me see. Let's go down. It went up. Did it go up? No, it went down. So it's somewhat in real time. It's just delayed like all the Fed data. This is the balance sheet. And as the balance sheet reduces, this is quantitative tightening. When the balance sheet, if we zoom out, increases, this is quantitative easing. And a lot of people relate or correlate or maybe even depend on this quantitative easing to start perhaps an altcoin season in crypto or a more bullish explosion period in assets everywhere. A lot of people are holding their breath for it. The correlation, I don't think, is perfect. 2019 in September, we began this process. It peaked out in May of 22. So this was kind of past the peak of Bitcoin and crypto or stocks, etc. But as we see this begin to reverse, which unfortunately we haven't. So this is something I wanted to warn you guys about, and I have been bringing up, is quantitative easing doesn't just necessarily end when they say it ends. In this sense, what I mean is they may discontinue this practice, but there are still maturity dates on assets and things that they own that are unwinding slowly. So it will take a little bit of time, and we can actually see this is true as they set that date for December 1st. Yep. And for some reason now, and we can't look at it. There was a December 1st plot. Either way, we can see that that has not ended completely. Now, it may have lessened. We may be seeing less of a runoff of quantitative tightening, and I believe that that trend will continue logically, but it will take a little bit of time. This isn't, is an important note, this is not quantitative easing just because they're ending quantitative tightening. It does not flip the script in that way. It doesn't just begin because one ends. Typically in the past, we have seen some kind of crisis or some kind of event that warrants it, some kind of emergency where the Fed jumps into the quantitative easing phase, like in 2020 when they really took off after COVID, etc. Basically during like economic crashes, economic hard times. Where am I in my notes? We'll see the update to the dot plot to the summary of economic projections. We'll see revised forecasts. So this will be interesting as well. The Fed does not have October data. Remember, the FOMC in October also doesn't have October's data because it's not over. But they are lacking what? The GDP, the employment, and one more number, maybe like inflation number, CPI, I don't remember. They're lacking some information. So that is definitely going to draw a little bit of uncertainty when it comes to what they're going to do and say. Now, it's pretty likely, again, that the 25 cut will come in. It's unlikely that they'll say we're going to start quantitative easing anytime soon. They may give further details on the tightening or the unwinding of that tightening. They certainly will update the dot plot and give us a more updated projection on how they see the interest rate into the next few years. Oh, yeah. And here is maybe where I'm going to caution you guys. So the interest rate cut, I think, is going to happen. You look at poly market, you look anywhere, right? And you're going to find everyone is in agreement. So at this point, it's almost like it'll happen just because we're in agreement. If the Fed doesn't do it here, they know what will happen, and that will be bad. I think that's the easiest way to put it. The Fed set out to do these cuts during this year. At the beginning of the year, they said they were going to cut by, was it 75 BPS? They've cut by 50. We're at the last meeting. That would make 75. Everything is really on track. This is a poly market. I don't know if I said that. But this is the kind of but it is likely that Powell will give forward guidance, meaning discussing what we should expect into the next meetings, that suggests a slowdown to these cuts. We have cut rates actually very quickly. Typically, it takes many years for our rates to come down like this. The Fed has acted really quickly despite criticisms from lots of people who don't know what they're talking about. But here's how I see it. Powell is leaving May 2026, and that is like a 99% certainty. Trump is going to replace him, and he will be no longer Chair Powell. He will just be Powell of the FOMC. He'll still be a member, he just won't be the chair. I believe that he is going to likely pause cuts until his chairship is over, unless there's some kind of outlier event or something. I think that is the likely outcome. He has a legacy, whether you agree or not, of a very successful chairman who has managed his dual mandate, I would say, honestly, pretty close to the best of his ability. Maybe there was, he's not perfect, but damn well. And he's going to defend that legacy. He is not going to burn the barn down on the way out. He's not going to just let everything go because he's leaving. He actually cares about the position, whether he does the right things or wrong things, and he cares about his legacy as chair. He does not want to leave the office as the chairman who allowed inflation to run wild while he was chairman. So he's likely to do everything that he can do until May to keep this under control, regardless of what we want or what we think is best. So that may be enough for markets to react negatively. We'll see. Because that is almost certainly happening. Inflation has held sticky over this time, around 3% from 2.6% earlier in 25. Unemployment has edged up. So the Fed's likely to be dovish. I think that's needless, not even needed to be said. Despite pressures, resiliency, yeah. So key takeaways from the economy this year. This will be the third cut. We already said that. This will bring the funds rate down from the higher levels of last year. The economy proved surprisingly resilient, which is interesting because we've just gotten so many weird numbers when it comes to unemployment and things. Real GDP growth was forecasted at 1.5 to 1.75%, and that showed more normalization rather than a recession that people have been talking about. Of course, this was offset and bolstered by technology and basically AI. I kind of speculate if you remove AI from the U.S. economy, meaning in a magical hypothetical, you just simply, put it in its own thing, count it differently. If you look at the U.S. without it, I imagine we are not doing so hot. I think our economy right now is largely riding the wave that is AI. And that's a risky place to be, to have so many eggs in one basket. Inflation still remains above target. Going into 26, like I said, we should expect slower paces of cuts, and maybe even if one, right? Maybe even if one. Post-May, things get very interesting. Depending on who Trump puts into that position, anything can happen. It is possible that the Fed acts completely differently than it ever has in the past, depending on who gets in there, what kind of influences are there. Post-Powell, the post-Powell transition. It's going to be sad. So we really only have, 3 more FOMCs with Chair Powell? This is such an end of an era. It's so sad. Gina's gone. Asian Gina never stayed. Chair Powell is leaving. It's okay. We'll go on. My heart will go on. And so will we. So will you. We did the warning. We did the walkthrough. What's likely today? We already did that. Balance sheet, quantitative easing, quantitative tightening. Obviously the focus. This is really impactful, especially because we already assume we know what's going to happen during this meeting. Yeah, that's a pretty good wrap up. We got through that in 19 minutes. Usually that takes me a little bit longer. We do have 11 minutes until the interest rate decision is in. Bitcoin has begun climbing, maybe already begun reversing into the decision being published. What else do we got here? Give me 1 second. Hey, Pickle, could you shoot me a text if you can hear me? Shoot me a text. Tell me, has the stream been stable? I made a bunch of changes from the last few unstable streams we've had. Can you just let me know? I won't be able to see it in the chat right now. Yes. Give me 1 sec. While I do this, guys, please smash the like button, subscribe, share this with your friends, join the crew, hype it up. I'm going to be getting into the chat in just a minute. We're going to maybe do some analysis, look at some other things going on, like silver, need some altcoins, dollar, Bitcoin, etc. Keep it going. Let me see. Thank you, Pickle. I got alerts from Ethereum already. All good. Sounds good. Let's go. Oh, somebody gifted memberships or something too. Thank you, brother. 50 memberships, Chieftain. My guy. Holy shit. Give me a sec. Wildin'. Wild. Okay. See everything good. 1,000 viewers. All right, we're good for not even being at the meeting yet. We got some good viewership. It's definitely quieter than it's been on previous FOMCs. I kind of expected that. That's okay. If you guys just continue doing your best here, keep hyping up the live, keep hitting subscribe and likes, that will help out. Okay. Everything looks pretty good. Pretty good. Pulling up the chats. There we are. I don't think anybody's chatting over on the... No one ever chats on the X stream. I don't know what's up with that. I guess it's not... just not what people do on X live streams. That's all right. I pulled up the chat anyway. What about OI? Open interest? Hey, what's up, Ravi and Mo? You guys said something. Data in 10 minutes. That is correct. We have just minutes to go. Not even 10 minutes. Less than 10 minutes. Boop. Less than 10 minutes. Oh, it's doxed me there. Less than 10 minutes to go for the interest rate decision. By the way, you might as well now open up your tabs. We like to do a little ceremonial thing where we all open up a browser tab, a search engine, and after 2 p.m. we all look together and we try to be the first to put it in the live stream what the interest rate decision is and the source. It's a fun little tradition. My guy, Chieftain69, shout out to this dude, man. Gift 50 memberships. What a G. If you got a membership right here, right now, first of all, everybody thank Chieftain. That's crazy. I don't know how long ago that was. I got no alerts. I can't add him for some reason. Maybe he's still not here. Maybe he already left. I hope not. There it is. You've chatted. There you are, man. X is in my future. 𝐂𝐵𝐆𝐍 over there. Nice. Got me wrong. I got it wrong. Can I gift memberships? Oh yeah, I'm gifting mine. Well, I'm gonna rip them off here too. If you get one of these from Chieftain or myself, please put in some emojis. Show it off. These memberships come with a green name in the chat and emojis. It's a really great deal. It's the best deal. Do I think Bitcoin will go up? You mean right now in this meeting? I would not bet up or down in this meeting. I'd wait till after the meeting. Do I think Bitcoin is going up from here overall? Yes. In the short term, I do. Short midterm. I do. Bro only bought 5. I know. Well, it was 10, but there it is. Shout out to Chieftain. What a G. What a G. Very thankful. I'm very thankful. What's up, Michelle? Trav, D-Lo. Who's all here? Do I think Venezuela's going down? Probably. I would not want to be there. Personally. For your cycles are gay. I mean, I agree. The bad kind of gay. Down to pound. What's up, Philly Skills? Who else is here? If you're here today, let's type up the chat, boys. This is the last FOMC of 2025. You don't get another one. This very well could be the last cut, the last dovish meeting in months. So let's drink it in. Let's cheers. Let's toast to it. It patches. This is a good kind. I don't know, man. It's up to you. 25 cut for sure. I agree. I mean, I agree. You ready? Dude, I am so ready for 2025 to be over. Damn, son, where'd you find these? What's up, West Coast? I'm so ready. If you guys saw my video with Altcoin Daily, basically they started it out with me saying 2025 was a scam. And it was, dude, it was. We all got rugged. We all got rugged. I think that we get the cut today, but I don't really think it's going to be dovish. That's the thing. I don't think it's going to be a dovish meeting. I think it's going to be a hawkish meeting. Head and Shoulders crashed to 70K. Hair looking good. Thank you, man. Thank you, brother. Looking at Corn saying, what is it? Well, unfortunately, it looks like we have the 4th in the series of The Simpsons. We have Bart, the 27th Bart, the December 1st Bart, the December 3rd Bart, and then again, it looks like we have the December 6th Bart. Quadra Bart, maybe Penta Bart coming in. I don't know. I'm tired, boss. I'm so tired. I'm so tired. I'm putting Bart Simpson on charts. Let's be honest with ourselves. This is hard times. Do I think Bitcoin's going up? What do I think's happening? Here you are. This might be a sloppy chart. We'll see. This is what I think Bitcoin's doing. If you haven't tuned in for the last week or two, understandable. It's been not so exciting. It was much more exciting before that. We have now sold off essentially for 50-something days. It's crazy that's been that long. 65 days. We have sold off from 65 days from our all-time high. Feels like way longer. Story of 2025. Here's what I think's happening. I think Bitcoin is looking to retrace. Now at 93.5, 93.3. You guys saw me, heard me, watched me fill a short there. I still have it open. I think it's cooked. We have been looking for this magical number. It's about 106K. Of course, it can be higher, it can be lower. This is, in my opinion, the most likely next move. What is going on here on low time frames in Bitcoin looks pretty strong, looks pretty good. And I think that that will result in a retracement from the all-time high to our recent low. This brings us to the golden Fibonacci retracement, the 618. It is the 106K target. You will also notice confluence on virtually every time frame, virtually every indicator. When we just throw on our daily moving averages, you will see that the 200-day is quickly moving towards that 106,000. Perhaps when they cross, even, will be a good time to target, or maybe will be a good indicator that Bitcoin's looking to make the move in the shorter term when the 200-day crosses 106. If you look on the weekly time frame, it really just everything. The confluence here is unimaginable. Like, it's everywhere. This was support on the week before our lower high. We fell very inefficiently. The market now looking to fill in some of that efficiency. Bait in longs, stop out shorts. The problem here is if we make it to 106 and we reject, and remember, I don't know the future. No one knows the future. I'm not a tarot card reader or fortune crystal ball holder. I don't know. If we reject from here, we start to look a lot like something we've seen before. In fact, something that we've seen maybe almost every bull market, with little exception. When they end, we tend to see a move from the all-time high downward, breaking the 200-day moving average. We have seen price return to that 200-day, and on that return, things get kind of optimistic again. Usually, it takes a while to build up that momentum, and then we shoot up, and sentiment quickly flips bullish, only to be sold into, creating a lower high. Price selling off, returning to our lows down here from November, and obviously in the worst case scenario breaking, sets us up to look exactly like pretty much every bear market start we've had in memory. This is an uncomfortable position to be in. I am looking to hedge at 106K. I'll probably start at 100. I mean, I already have that little short open at 93. I'm not going to be all out. I'm not discounting. I'm not throwing away the idea that Bitcoin can't go higher, though the 4-year cycle would have to break. That's possible. I'm not discounting. I'm not throwing that away, but I'm preparing either way for either scenario. If the bull run is over, I want to have something taken out. I want to have some of that dry powder in reserve for the next year. But in the off chance that the 4-year cycle is bullshit and we just keep going, I certainly don't ever want to be out of Bitcoin all the way, and never have, and I certainly won't here. I want to also have enough to comfortably ride kind of the outlier super bullish scenario. That is the best non-financial advice I can give anybody, is to prepare yourself, whatever that means, for the bull market to be over after some kind of failed high, and for the 4-year cycle breaking, super cycle, whatever it is, right? Prepare yourself for both scenarios. It's going to look different for everybody. It doesn't have to involve leverage. Spot is usually the way to go. But this is what I think is happening. I think Bitcoin is going to break up from here to this 100-ish to 106K area. And we're really going to see what happens. We're going to find out if the bull run is over or if something new is happening. We're going to find that out very quickly, in my opinion, by the end of the month for sure. Our weekly KJ sits up there. Our TK is coming down. Ooh, it's 2 p.m. I messed up. I was in the zone. You guys asked me about charts and I got all into it. It is 2 p.m. The interest rate decision is published. Who's got it? Who's the first one? Put it in chat. Put a source. Ooh, Bitcoin moving up. It's liking it. I missed it. Wow, I'm a turkey. The S&P rocketing. I almost said some weird words. S&P rocketing off of this news. I'm going to look in the chat. I assume it's 25 BPS, potentially higher, but I assume it's 25 BPS. That did not work. What? There we go. Done. Anyway. S&P rocketing, Bitcoin breaking its high, but already retreating. Volatility is kicking in right here, right now. Things are getting interesting. Are my sunglasses Nevin? No, these are old. The dollar dumping. Finally, the dollar showing weakness at all. Over the last few FOMCs, the dollar has really taken the show on a lot of this price action. It is great to see Bitcoin and stocks moving upwards on this news. I'm going to look, just add gold down here. Gold, of course, following suit. 25 beeps. Absolutely crazy shorting these all punches, I bet. 25 beeps. 25, put it in chat. 65-day saxophone. Chart looks like Chris's saxophone. 25 beeps, 25 beeps. 25 beeps. FBTC, we'll look at FBTC. I said that a little bit ago that I did get some alerts for Ethereum. Likely a spicy move is happening. Let's check this out. So interest rate is in. As predicted, it's 25 BPS. That's really just what the market was expecting. Anything else? Honestly, anything else could have been bad. Could have been not good. Did this show up here? Federal funds rate, yep, down 25 beeps. Good, good. Bitcoin doing as it does here. Ooh, Ethereum breaking 3,400. Okay, let me, we'll tune over to Ethereum here in a second. Rocketing up, back down. This has been every FOMC now. You guys, if you've turned into the last like 4 or 5, we have seen something like this. We have seen something where price moves in one direction instantly and then reverses and moves past where it started. This is some BS, some manipulation BS. Again, why I warn you every FOMC. Every FOMC, I'm like, I don't need to say it this time, but every single time, I'm like, no, I do. Because people are going to get riggedy wrecked. At the BTC, are long looking good. We've broken past, if you guys were here over the last few days, talking about our high here from early December breaking, and all of a sudden, me getting bullish on Ethereum again. That is continuing here, putting on gains against Bitcoin after escaping its downtrend. Looking for a bigger retracement. Let's see quick. Okay. Next, 038, the 618. Also our wick high here on the 7th of October. Ethereum looking good, man. Pulling itself up. I still believe that we have higher to go. It doesn't really seem to fit in with anything else, which is odd. That's okay. That's okay. Looking for that 0.05 as we've been looking for, man, for like a year. This market has moved so slow. Ethereum versus ETH was looking very weak. Pretty much all of November. This price action was incredibly weak, and it was impossible to say that this was basically a good thing, right? We had a flat bottom. Support was being tested over and over again. Our highs were coming down consistently. This looked bad. But with one move, Ethereum managed to basically undo that. Test support one more time and now begin trending up with a higher high. This is looking juicy. Juicy, juicy, juicy. That could get good. That could get very good. FBTC, that does look great. We had to wait forever. How long were we waiting on that 033 long? Like for months? 2 months? Maybe a little more. On the monthly, FBTC back to 0.4. Trading above a 0.04 gives you the 3 rising methods. 3 rising methods? Candle, chart candle, pattern, setup, whatever. I would say puts that 0.05 into obvious target, as really I think it always has been. I still think this is going to happen. I just have no idea on the timeline. F against dollar. 36, 35. Not showing as much strength as I would have hoped, and that's likely just because Bitcoin is not having the biggest day yet. I like that climb. A lot of charts after this bottoming in the 25th of November have actually looked stronger than Bitcoin. I've remarked on that a few times. I think I said it specifically about Link and a few others. Do we have any alerts for those? No. No other alerts. Largely sideways for crypto at the moment. Despite all that volatility, Bitcoin is pretty much just where it was. It traded high, it traded low. It's basically back to where it was. Another example of why we never encourage trading on the FOMC days. Coming back up. Wow. Can you believe that this has been the price action since that low? It's been 22 days. How has it been 22 days? Shit's taken forever. 20 days. 20 days of the same price. This has been the craziest year of sideways. Man, you got to break out. Got to get out of here, Bitcoin. Got to keep going. You can't just keep going sideways. I guess you can. Do whatever you want. I don't want you to keep going sideways. Of course, the dollar continuing to sell off, but stocks doing better than Bitcoin. This has been how it is over the last few meetings like this. It's kind of annoying. Still underneath their December high, but a nice green candle here for SPX, 0.36%. Maybe they're not so lucky. 0.63. Looks like so much more. But holding on to those gains, stocks painting a higher low where Bitcoin did not, showing just a little bit more strength. A little more strength. We have 22 minutes until Powell speaks. This time we're not going to miss it. I was in the zone. There we go. Pull up the chat again. What's up, Kiera Diaz Morrow? We have to have more new people, more subscribers than that. I refuse to believe there's only 2. YouTube has not really been doing a great job of telling me when we have them. What's up, Aussie? Jim Risner over on X, 𝐒𝐈𝐆𝐍 over on X. Real quick, we have 1,600 votes on the poll. We can have more than that. We should have more than that. Let's see who was right. 64% of us were correct. 64% looking for that 25 beeps. 28, 36% of us a little bit off. Nothing to worry about there. This has already ended. We already know the answer, so there's really no point in continuing the poll. I'll close that one. Let's start a new one up. Powell's speech will be blank. Dovish. We'll do a dovish hawkish. Let's do bearish restrictive. And we'll do nothing burger. Everybody loves that. Put a new poll there. Keep voting in them. Keep tapping the screen. Keep liking and subscribing. It's helping out. All right. Feb to buy 40 billion in 30 days. What is that? Damn, stocks continuing. S&P still moving here in higher highs. Bitcoin just struggling with where it started. S&P putting in more. The dollar looking like it's continuing its weakness here. I have 2 of the same chart open. I do. Let's pull up the dollar. Used to trade days like this. You learn not to. St. Airways. Exactly, brother. Exactly. Today is not the day for trading, in my opinion. The dollar holding on to its lows from December, at least for now, but that is a very weak lower high. With today's movement, I would not be surprised to see the dollar continue down to kind of like year lows, last year lows. This double top here was pretty gnarly. To see this return to like 97, I think makes a lot of sense. And maybe that's beginning now. And dollar's losing more ground here, breaking lower lows in real time during the live, down to 98.8. Come on, Bitcoin, do something. I'm so sick of Bitcoin. This is really it. I'm just so sick of Bitcoin sitting out the moves. It's like, yeah. What's up, Ethan Hall, Assad, Jamal? What's up, brothers? How you doing, Stone? FBTC climb while Bitcoin does nothing is great. Well, I did have a theory that I don't like saying because I think it's very scary. And it's maybe a theory of mine because it's so scary. Is that once we're in the bear market, and once the high is behind us on Bitcoin, that we see an alt season, but that alt season is just alts making up ground against Bitcoin in their BTC pairs, but not actually putting in highs in their dollar pairs. So trading sideways or maybe selling off, going down, but gaining against Bitcoin. I think it's the ultimate pain scenario. All of these people who have been waiting for alt season every day, every week for years, see Bitcoin go down, they see their alts going down in dollar value again, and they likely don't even realize that they're gaining against Bitcoin. Bitcoin dominance goes down, like in an alt season, and things look really weird. I honestly hope that's not the scenario. But it feels kind of like maybe it is. Maduro is in charge. More cowbell. You're trading today? You're up trading. Get it, brother. I mean, cheers. Like, do it, right? I just, I caution. It's a really easy day to lose your hat. More cowbell. Who's here on the YouTube? 𝐂𝐴CHAN, 𝐂𝐴CE, Bill Brower, Bob Saget, Brad TA, Cavalaria, Chris Pompeo, Coca-Cola, Cool Cat, Crypto Surge, Crypto Arrow, Crypto Stevo. What's up, boys? David Williams, Desert Crypto, Echo Leaf, Eduardo, Gundeco, El Cheeto, Gundam, Jalal. What's up? Adam Buzzard, did I get you, bro? Never would miss you. Blue Mountain Fire, what's up, bro? Amused Ripple. What else is here? GT Gundam. I got those. James C, Jeff D Crypto, Jets, John Calls, Johnny EXP, Julio Energy, Kevin McGee, King Peasant, there you are. Kong Jr., Cood Jax, Leon Hoffman, Levon, Lift the LT Umble. Dude, these username handles are so much harder to read. Nick Young, Mr. Dinkles, Michael Picazzano. What's up, bro? Good to see you, man. Michael Evenchick, you're the one trading and doing well. Cheers. Nick Young, Nirvana, Philly Skills, my guy. Steve, Optical Art. Check out Optical Art. I miss you, Steve. I gotta text you. We gotta catch up. It's been a little bit. Rave Song Records, Real Madrid, Real Triple, Robter, Ruben, Miranda, Ryukin, Sino, Sayori, Solana Man, Saint Airways. What's up, brother? Sin, TBJ, Tevins, Thu Videos, Tom G, Tonzi Norman, Thorador, Truth Wave, Tusk Reaper Gaming, Wayne Batson, Z-Man. What's up, Zach? Where's Zach at? I know you're here. Space Signals, Mickle, Brick City. How you doing? How you doing? Who else did I miss? Longest shout out. It's not. There's been longer. There's definitely been longer. This is FOMC. We have 1,600 of the smartest, handsomest viewers out there, but we've had some bigger streams. We have more names. What's up, brothers? What should we look at? Beautiful hair. Thank you. You're in the camp of nothing burger. Honestly, I'm going to stick with my predictions from the very beginning of the stream. I think so far they're spot on. I think that will continue. Meaning there will be likely a small update on the quantitative tightening. Maybe just we did it, like we stopped doing it. I don't think there will be much update on quantitative easing, if any, and I think that the forward guidance will be a cautionary pausing of interest rate cuts. We had 3 interest rate cuts over the last 12 months. That's very quick. It's a very fast cutting cycle, and I think Powell is going to put the brakes on that. Maybe that means we won't see any cuts until post-Powell, after May 2026. Maybe one, but I think that'll be it. Do you still like Powell if he pumps Trump's market? I don't know. Of course. I like Powell pretty much no matter what. He doesn't have much time left anyway. Nothing burger, classic order. Possible. Say the word data. Powell will definitely, I think, say the word data. He definitely will say good afternoon. What other bets do we have going on here? You guys are degens. Polymarket. Dude, Polymarket. How, not Polymarket. Prediction markets. How are these a thing? Think about it. It's just, now you can bet on anything. And it's like insider trading is legal. Like there could be a Polymarket about me. Will I go to Bitcoin 2026? And I get to decide and I can bet on it. That doesn't make sense. It's just crazy. It's insane. Let's see. Fed Polymarkets. Trade on Fed. What do we got? This is not an endorsement. I'm not saying you should use these platforms or anything. Simply looking at these. Gambling is bad. Fed decision in December. We already have that. Who will Trump nominate as the Fed chair? 50% Kevin Hassett. I think that's pretty accepted here, right? Kevin Hassett. What else do we got people betting on? This is wild. How many Fed cuts? That's in 3. Fed decision in January. This is going to be interesting. Volumes are bigger than I expected. 78% no change. That'd be the camp I'm in. We have 13 minutes. I gotta keep my eye on the clock. Powell out as Fed chair in 2025. This is the dumbest bet. What did I go up to? People were betting 23% yes. God, this is why I just realized it. So I was complaining, maybe I was bitching a little about all of the bullshit, all year about what the Fed was gonna do, about what Powell was going to do or what was going to happen to Powell all year, every month. We kept hearing the same bullshit, and it was pretty baseless, in my opinion. I think this is it. This is why, is because of these markets. People, it is all of a sudden profitable to tell people the wrong information. If we can get enough people to believe the wrong thing, this is what they're saying, then you can manipulate the market and you can make money on it. So you can make money from spreading false information. Is that kind of it? Is that the 2 cents? I don't know. It's terrible. It's not good. What's up, R-Trade? Good day from Australia. How y'all doing down under? Just a bet. Gamblers gambling. Truth. Pink tie. Are we betting on the people betting on the tie colors here? We have like 10 minutes betting on you. Thank you, Ed. I'm betting on all of you in 2026. Is having a puppet as the Fed chair next year a good or bad thing? Tico, if you ask me, it is absolutely a bad thing. I can hardly imagine the argument for it's a good thing, though I'm sure people would make it. That's my opinion. Obviously, it's a bad thing. There are checks and balances and separations of powers, even though the Fed isn't government, for a reason. That's my political science background. The next meeting is already more important. It always is, baby. How many ladies will Tom at the next conference? Oh, year of the search for data 2025. Or the year of the snake, because it was. Will Gina be there? Oh, I wish. Printing money is a bad thing, but it pumps the markets. Well, the Fed is not really, I won't get into it. The Fed is not necessarily the money printer. Oh, Andy from Bitcoin Census, Fed Chair 𝐂𝐡𝐚𝐫𝐭. I nominate myself for Fed Chair. Trump, if you're listening, which you are, I nominate myself. Powell's already ready. He's already ready for new chair. Everyone's welcome to their opinions. Should we watch last month's introductory statement? Powell's statement in the October's. Should we watch his previous keynote to compare? We've been doing this every stream. I don't know if you guys like this element. I'm going to put that up as the next poll. But if you want to watch the last FOMC's keynote, it's 7 minutes. We have enough time. That'll give us a few minutes before the FOMC starts. Put a 1 in chat. I think it's a good practice, but I don't know if it's like too boring for you guys. Well, it is literally. You talk too much bullshit. All right, bud. If you think so. Because Tom likes it. I think it's important. How would I start it? I would start it good afternoon. Wow, this guy comes and just talks shit on me all the time. Okay. All right, Katoshi 77. 111. You can put a 2 if you don't want it. Seeing a good amount of 2s. All right. It is very boring. I think it even kind of like gets us a little hypnotized, a little zoned out before he begins speaking. And I think it burns a little of my tension fuel. So maybe it's not a good thing. Play the song. All right. That I can do. The Federal Reserve. It has 15,000. Look at this. It says it has 15,000 people watching. You know what's funny is we saw this maybe it was in October, maybe it was the meeting before, where it had like 500,000 watching or something. It was bots. I remember seeing it in real time and being like, whoa. And then going back and looking at the stream post live, so basically after YouTube processes it, and the amount of views were like way down. It was like almost 1 million views, I think, and then it was maybe like 200K after. So it was like all bots. Someone is botting the FOMC, the Fed's account for viewers. Isn't that weird? What's the point of that? I don't know. No idea. It's very strange. Oh, I almost blew the speakers out. Let's do a little volume test. Hey. I do love this song. We have to throw this song away, basically. Won't make any sense once he's not chair. Won't make any sense. We got, let me see. 1,400 viewers. Looks like we just lost some. YouTube's weird. If you're one of those 1,400 on youtube.com/TomCrown, I want you guys to hit the like button. Hype it up. Powell will be speaking in just minutes now. The true chairman. Yeah, he's the chairman of the board. I'm gonna miss him. Love him or hate him, I'm gonna miss him. Gonna have to come up with new jokes, new inside jokes. I'm not ready. I'm not ready for a new chair. 6 minutes, boys. What should we do? Did he talk already? 6 minutes. They're slinging my water. Hold up. Whatever. All right, boys. 4 minutes. What are we doing? What are we doing? Total still looks like crap. Inching up. I think it's going to make the mirror move to Bitcoin, obviously. 3.6. Let's get tether dominance here. Tether dominance is possibly doing what we were hoping for. We have 3 lower highs, lower low yesterday. Let's see that downward pressure. Watch him speak now. I turn this off. Check. Check, check. Watch your speakers. Now we're good. Go. There we go. Seconds away. And here we are at the last FOMC of 2025. It's been a long journey, boys. The year did not pan out as we were hoping. Right? There's always 2026. Stay optimistic. Let's stay hopeful. You're in your chair wasting your life. Me too, man. Me too. Blaze it up. Light up. Roll up. 𝐂𝐽𝐫. How's 𝐂𝐽𝐫 doing? Solana, please. We don't really have time to take chart requests, everybody, please. We only have 2 minutes and 30 seconds. 2 minutes and 20 seconds. Solana back to 143 like clockwork. High or low? Testing resistance. It's a good sign. How many tests here? 1, 2, 3, 4, 5, 6, 7, 8. $143 being chipped away at. Higher lows coming in. Solana, in my opinion, still looking for a breakout. 190 is my target, but here it is. But the more recent trade position that we put out here, looking to cut it shorter at like 168. Basically November's close up here. Trade looks good. I don't know what Solana's future holds, man. This is a weird chart. This is not the best looking chart if you don't get an all-time high, right? Starts to just look like a gnarly head and shoulders, or maybe a diamond reversal. Something like that. Not the best, but I'm keeping an eye on it. Keep an eye on all the charts for you. You know we do. The meeting about to begin. I believe we're 55 seconds away now. Good afternoon. Head and shoulders, knees and toes, knees and toes. Every alt chart looks like absolute garbage. That is rather true. There are a few that don't look quite as bad, but yeah, man, the whole market looks like trash. Where's your Twitch stream? I'm sorry, Eternal G. We've been having connection issues. I know you're holding it down over there. So we decided to cut the other streams just for today. We're live on X and YouTube, and that's it. And so far, the connection's been better. It's not the only change we made, though, so could be something else. Powell coming in. Should be here in 2 seconds, but this man is never on time. I'm going to turn up the volume here. Fashionably late, as usual. Great time to hit the like button. Welcome in. TOMPOW now speaking in just seconds. You are tuned in at the right time. You've missed nothing. Roll up, grab your brews, hit the subscribe button, share it out with your friends. This is the last FOMC of 2025, and it's going to be spicy. There he is.
Good afternoon.
Damn.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although important federal government data for the past couple of months have yet to be released, available public and private sector data suggests that the outlook for employment and inflation has not changed as much since our meeting in October. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals, in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by 1/4 percentage point. As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves over time, thus supporting effective control of our policy rate. I will have more to say about monetary policy and its implementation after briefly reviewing economic developments. Although some key government data have yet to be released, available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. In contrast, activity in the housing sector remains weak. The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter, reflecting the reopening. In our summary of economic projections, the median participant projects that real GDP will rise 1.7% this year and 2.3% next year, somewhat stronger than projected in September. In the labor market, although official employment data for October and November are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. The official report on the labor market for September, the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by 1/4 percentage point to 3.5 to 3.75%. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. A reasonable base case is that the effects of tariffs on inflation will be relatively short-lived, effectively a one-time shift in the price level. Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem. But with downside risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by 1/4 percentage point. With today's decision, we have lowered our policy rate 3/4 percentage point over our last 3 meetings. This further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through. The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement, or repo operations, are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning and should be used when economically sensible. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Fed, we will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
No, you don't.
Howard.
No, you don't. Let's go. Here's the questions.
Thank you. Howard Schneider with Reuters. Just first turning to the statement, just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
And if I could follow up on the outlook there, it seems like with the additional GDP growth coupled with easing inflation and a fairly steady unemployment rate, this seems like a pretty optimistic outlook for next year. What's given rise to that? Is this an early bet on AI? Is there some sense of improving productivity out there? What's driving that?
So a number of things are driving what's happening in the forecast. And I would say if you look broadly at outside forecasts, you do see a pickup in growth in many of those now, too. So it's partly that consumer spending has held up. It's been resilient. And to another degree, it is that AI spending on data centers and related to AI has been holding up business investment. So overall, The baseline expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually, some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025. So it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive. And as I mentioned, AI spending will continue. The consumer continues to spend. So it looks like the baseline would be solid growth next year.
Steve.
Thank you, Mr. Chairman, for taking our questions here. You had previously described rate cuts in terms of a risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts over here, and have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that. And the data that we get are going to factor into our thinking. But yes, we have, if you go back, we held our policy rate at 5.4% for more than a year because inflation was high, very high, and unemployment and the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down, and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September, and we've cut now 3. We've now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
If I could just follow up on the SEP, you have a whole lot of big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So the implication is obviously higher productivity. And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time. So it's basically a good thing. But that's certainly the implication.
Bullish on our suffering.
Thank you. Colby Smith of the New York Times. Today's decision was clearly very divided. It wasn't just the 2 official dissents against a cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned, and as I've mentioned here before, the situation is that our 2 goals are a bit in tension, right? So interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks, and what does your forecast look like, and where do you ultimately where do you think the bigger risk is, and it's very unusual to have persistent tension between the 2 parts of the mandate, and when you do, this is what you see, and I think it's actually what you would expect to see, and we do see it. Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed. They're very thoughtful, respectful, and you just have people who have strong views, and we come together and we reach a place where we can make a decision. We made a decision today. We had 9 out of 12 supported it, so fairly broad support. But it's not like the normal situation where everyone agrees on the direction and what to do. It's more spread out, and I think that's only inherent in the situation. In terms of what it would take, we all have an outlook in terms of what's going to come, but I think ultimately having cut 75 and the effects of the 75 basis points will only begin to be coming in. As I've said before a couple times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that
as long as I'm talking about the data,
we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the
my headphones, no.
For the household survey, we're gonna look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. I mean, you talk about it in a very positive way, just given the complicated nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions, and you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I mean, I could make that case. It's a close call. We have to make decisions. And we always hope that the data will give us a clear read, but in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
He said the word data so many times my brain turned off.
Nick Timmerosa, The Wall Street Journal. Chair Powell, there's been some discussion recently of the 1990s. In the 1990s, the committee did two discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down, or should we think of policy risks as genuinely two-sided from here?
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year. But when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3 is not a big data set, but you are right about those 3 cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years, and indeed the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from the notwithstanding the 150 basis points in cuts prior to today?
So I think the idea is that with now having cut 75 basis points more now, and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see, any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation, and as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation, but we're going to start to see the data, and it'll tell us whether we were right or not.
Claire. Claire Jones, Financial Times. A lot of people interpreted your comments at the October meeting that, when there's a foggy situation, we slow down, to mean that, there wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the committee decide to move today rather than to move in January instead? Thank you.
Right. So in October, I said that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently. So why did we move today? I would say point to a couple things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000, so that would be negative 20,000 per month. And also, just to point out one other thing, surveys of households and businesses both show declining supply and demand for workers. So I think you can say that the labor market has continued to cool gradually, maybe just a touch more gradually than we thought. In terms of inflation, it's come in a touch lower, and I think the evidence is kind of growing that what's happening here is services inflation coming down, and that's offset by increases in goods, and that goods inflation is entirely in sectors where there are tariffs. So that does build on the story, and so far it's only a story, that that the goods inflation, which is really the source of the excess at this point, almost more than half the source of the excess inflation is goods, is tariffs. And you've got to say then, so what do we expect from tariffs? And I would say that is to some extent down to looking for broader economic heat. Do we see a hot economy? Do we see constraints? Do we see what's going on with wages? You saw the ECI report today. It doesn't feel like a hot economy that wants to generate, Phillips curve kind of inflation. So we look at all those things, and we say that this was a decision to make. It obviously wasn't unanimous, but overall that was the judgment that we made, and that's the action we took.
And just on the ample reserves point, how concerned were people around the table about some of the tensions we've seen in money markets? Thank you.
I wouldn't say concerned. So what really happened is this. Balance sheet shrinkage, sometimes called QT, went on. We had a framework in place for monitoring it, and nothing happened. The overnight reverse repo facility went down pretty much close to zero. And then beginning in September, the federal funds rate started to tick up within the range, right? And it ticked up almost all the way to interest on reserve balances. There's nothing wrong with that. What that's telling you is that we're actually in an ample reserves regime. So, we knew this was going to come. When it finally did come, it came a little quicker than expected, but we were absolutely there to take the actions that we said we would take. So, and those actions are today. So, we announced that we're resuming reserve management purchases. That is completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big? The answer to that is
also what you said. Thank you.
If you look ahead, you'll see that April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen anyway. It was going to happen because April 15th is April 15th. There's also a secular ongoing growth of the balance sheet. We have to keep reserves, call it constant as it relates to the banking system or to the whole economy. And that alone calls for us to increase about $20–25 billion per month. So that's a small part. That's going on. It's also happening in the context of a temporary few-month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening there.
Claire Jones, one more time.
Thanks, Mr. Chairman. This is the last post-FOMC press conference before an important Supreme Court hearing next month. Can you talk about how you're hoping the Supreme Court will rule? And I'm just curious why the Fed's been so reticent on such a pivotal matter.
It's not something I want to address here, Andrew.
Why would you think it is, Andrew? Are you a
commentators.
Moron? Are you a
It's
moron,
before
Andrew?
the courts, and we think we don't think that we help matters by trying to engage as a public discussant of that. I'll give you a mulligan, though.
No, thanks. I don't know if I can take 3 questions, but
no, just one more.
I guess I wanted to come back to the 1990s question, and like, do you see that as a useful model for thinking about what is happening in the economy right now?
I don't think it rises to that level. So I did think that in 2019, where we cut 3 times, but this is such a unique situation. It's not the 1970s, let's put it that way, but we do have tension between our 2 goals. And so that's just unique in my time at the Fed, and I think going back a long ways, we haven't had that. In our framework, as you know, says that when that's the case, that we try to, take a balanced approach to the 2 things, and we look at how far they are and how long it would take to get them back to each of them back to the goal. And that's a very subjective analysis, really, but it just tells you you've got to. And I think ultimately what it says is when they're broadly equally threatened or equally at risk, you should be kind of neutral, because if you're either accommodative or tight, you're favoring one or the other goal. And so we've been sort of moving in the direction of neutral. Now we're in the range of neutral. We're in the high end of the range of neutral, I would say, and that's what we're doing now. It so happened that we've cut 3 times. That we haven't made any decision about January, but as I've said, we think we're well positioned to wait and see how the economy
Only 3 more
performs.
Chairman Powell FOMCs left ever. Edward, be smarter than the last guy.
Thanks, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, the inflation expectations has come down in your SEP report. Do you see the tariff price increases as passing through in the next 3 months? Is it a 6-month process that we're looking for that to end? And then because of that, is jobs the threat to the economy?
So with tariff inflation, there's the announcement of a tariff, and then they start to take effect, and then it takes some months. Goods may have to be shipped from other parts of the world. It may take quite a while for an individual tariff to take its full effect. But once it's had that effect, then the question is, isn't that just a one-time price increase? So we actually look at it, all of the announcements and what you get from all that. You see sort of for each one of them, there's a time period, and then it's fully in. So if there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements, inflation from goods should peak in the first quarter or so, right, or roughly. We haven't been able to predict this with any precision. No one is. But call it the first quarter or so of next year should be the peak. And from here, it shouldn't be big. It should be a couple tenths or even less than that. We don't really have precision on this. And after that, again, if there are no new tariffs that are being announced that will take 9 months to get fully in, and 9 months is also an estimate, then you should start to see that coming down in the back half of next year.
And I want to see if I could address sort of the elephant in the room. The president's been talking openly about a new Fed chairman. Does that hinder your current job right now or change your thinking at all?
No.
No.
No mulligans for it.
Michael
McKee from Bloomberg Radio and Television. 10-year rates are 50 basis points higher than when you started cutting back in September of 2024, and the yield curve basically has been steepening. Why do you think that continuing to cut now, especially in the absence of data, is going to bring down the yield on the thing that will move the economy the most?
So we're looking at the real economy and focusing on that. And you've got to, when the long bonds move around, you've got to look at why they're moving around. If you look at inflation compensation, it's very, that's one part of it is inflation compensation break-evens. And, they're at very comfortable levels. They're at levels consistent once you get out past the very short term now. Break-evens are at at quite levels that are quite consistent with 2% inflation over time. So there's nothing happening with rates going up out there that suggests concern about inflation in the long term or anything like that. I mean, I look at these things pretty regularly. Same thing with surveys. Surveys are all saying that the public understands our commitment to 2% and expects us to get back there. So, why are rates going up? It has to be something else. It must be, an expectation of higher growth or something like that. And that's a lot of what's been going on. I mean, you saw a big move, toward the end of last year, which was not to do with us. It was to do with other developments.
Well, you just mentioned that the public is expecting you to get back to 2%, and Americans overwhelmingly are citing high prices, inflation as their number one concern. Can you explain to them why you're prioritizing the labor market, which seems relatively stable to most people, instead of their number one concern,
no one
inflation?
Thinks the labor market is stable. Are you smoking crack?
As you know, we have a network of contacts in the U.S. economy, which is really unmatched if you go through the 12 reserve banks. So we hear loud and clear how people are experiencing really costs. It's really high costs. And a lot of that is not the current rate of inflation. A lot of that is just embedded higher cost due to higher inflation in 2022 and 23. So that's what's going on. And so the best thing we can do is restore inflation to its 2% goal, and our policy is intended to do that, but also have a strong economy where real wages are going up, where people are getting jobs and earning money, and we're going to need to have some years where real compensation is higher. It's positive, significantly positive. So nominal wages are higher than inflation for people to start feeling good about affordability.
People's
the affordability
wages
issue.
need to keep up with
and,
prices.
So we're working hard on that. We're trying to keep inflation under control, but also support the labor market and strong wages, so that people are earning enough money and feeling economically healthy again.
Victoria. Hi, Victoria Guida with Politico. Just to follow up on that, I mean, this is now the third time that you've cut this year, and inflation is around 3%. So is the message that you're sort of trying to send with that you're okay with where inflation is for now, as long as people understand that at some point you still want to get back to 2%, because inflation is relatively stable where it is?
Everyone should understand, and the surveys show that they do, that we're committed to 2% inflation, and we will deliver 2% inflation. But it's a complicated, unusual, difficult situation where the labor market is also under pressure, where job creation may actually be negative. Now, supply of workers has also gone way down, so the unemployment rate hasn't moved that much. But it's a labor market that seems to have significant downside risks. People care a lot about that. That's their jobs. That's their ability, if they get laid off or if they're entering the labor force, to find work. So that's really important to people. The story with inflation, and we're well aware that this is a story at this point, is that if you get away from tariffs, inflation is in the low 2s, right? So it's really tariffs that's causing most of the inflation overshoot. And we do think of those as likely to, in the current situation, as likely to be a one-time price increase. Our job is to make sure that it is, and we will do that job. But right now, you've got this difficult balance, and there are risks to both sides. There's no risk-free path. If it was just inflation and the labor market was just really strong, and then rates would be higher, as they were for more than a year. We didn't have to worry about inflation. Sorry, about the labor market. Because the labor market, unemployment was very low, if you remember, when inflation was very high. There was a labor shortage, so we could focus entirely on inflation. Now, it's different. We actually have risks to both, and I think we're doing the best we can for people. They also care about their jobs. They do care about affordability, and the best thing we can do there is both to support economic activity, but also, make sure that when tariff inflation goes down and disappears, inflation lands around 2%.
Elizabeth. Thanks so much, Elizabeth 𝐒𝐚𝐫𝐿 with ABC News. Just to follow up, you keep talking about job growth being negative. Why do you think job growth is so much worse than some of the official data? Why do you think job growth is, to follow up on your comments about job growth, why is it so much worse than the official data is suggesting?
Oh, well, we know, I think I don't think this is particularly controversial. It's very difficult to estimate job growth in real time. They don't count everybody. They have a survey. And there's been something of a systematic overcount. And so we expected, and they correct it twice a year. So the last time they corrected it, we thought the correction would be 800,000 or 900,000. I won't get the numbers exactly right. And that was exactly what happened. So we think that has persisted. And so there's an overcount in the payroll job numbers, we think, continuing, and it will be corrected. I don't have the exact month in my head right now, and that's just, I think forecasters generally understand that. So we think it's about 60,000 a month, so 40,000 jobs could be negative 20, and that could be wrong by 10 or 20 in either direction. But in any case, but the thing is, that's job creation in a way. That's demand. Labor supply has also come down quite sharply. So, if you had a world where there's just no growth in workers and you really don't need a lot of jobs to have full employment, some people argue that's what we're looking at. But I think a world where job creation is negative, I just think we need to watch that situation very carefully and be in a position where we're not, pushing down on job creation with our policy.
When we're talking about supply, we have seen major American employers like Amazon cite AI in job cuts. How much right now are you factoring in AI into the current weakness in the job market?
So it's probably part of the story. It's not a big part of the story yet. We don't know whether it will be. But, for example, if you look at, you can't miss the big announcements of layoffs and also companies saying that they're not going to hire anybody for a long time, and they cite AI. That's all clearly happening. At the same time, people are not filing for unemployment insurance, and since job creation, job finding rates are extremely low, if there were big numbers of layoffs, you'd expect the continuing claims to go up, and you expect new claims to go up. It really haven't much, so it's a little bit curious. But longer term, though, the question is, what are we going to see here? And we don't know, but it's it may be that in past technology, really significant technology innovation eras, you have seen some jobs destroyed and other jobs made. Ultimately, what's happened for a couple hundred years is when you get through all that, you have higher productivity and you have new jobs, and there are enough jobs for people. This may be different. It's every time we have a wave of technology, we think, oh, this could put a lot of people out of work. What are they going to do? In the past, there's always been more work and higher productivity, and incomes have risen. What will happen here, we're going to have to see. But right now is such early days. We don't think we see much. It's certainly not showing up in layoffs yet.
AI is not going to make jobs.
Thank you, Chair. Enda Curran, Bloomberg News. Given the breadth of views on the policy committee, why is there such a division of views between
the policy what?
On the committee?
Thank you.
Why is there such a division of views between the presidents and the board members?
You know, it's not so stark as that. The views are more varied in each group as well. There's some of that, but I would say they're also governors and they're people on both sides in both groups. I wouldn't put too much in that.
Okay, and just to follow up, please, given your growth upgrade, how would you factor in, or what would be the economic impact if the Supreme Court is to strike down the tariffs that they're currently hearing, please, in terms of growth and inflation? Thank you.
I really don't know. It would depend.
He might be able to, but he probably won't.
It would depend on a whole bunch of things we don't know. So
It's the
I can't really help you there.
There is. Best answer there is.
Christine. Thank you. Thank you, Chair Powell. Christine Romans, NBC News. I wanted to ask you about how the higher income households are really driving spending right now. They're backed by home equity and stock market wealth, but lower income consumers are really struggling with the accumulation of 5 years now of rising prices. It's price levels, not really the inflation rate, holding some of these families back. How sustainable is this so-called K-shaped economy, and what are the Fed's thoughts on whether that's a risk going forward?
So we do, through our vast network of contacts and just through our observation of what's going on in the economy, we hear about this a lot. If you listen to the earnings reports for consumer-facing companies that tend to deal with low and moderate income people, they'll all say that we're seeing people, tightening their belts, changing products that they buy, buying less, and that sort of thing. And so it's clearly a thing. It's also clearly a thing that, asset values, housing values, and securities values are high, and they tend to be owned by people more at the higher end of the income and wealth. So as how sustainable it is, I don't know. Most of the consumption does happen by people who have more means. I think the top third accounts for way more than a third of the consumption, for example. So it's a good question how sustainable that is. The best we can do is to have a price stability and a strong labor market. And what we saw, for example, what we saw at the end of the very, very long expansion that ended with the outbreak of the pandemic, we saw that it was 10 years and 8 months or something like that, the longest one in recorded history. In the last 2 years, most of the largest part of the wage gains were going to people in the bottom quartile, the bottom part of the low and moderate income. So, having a strong labor market for a long period of time is really, really good from a social standpoint. It's helping people at the lower income levels, and that's what we all want to get back to. But we got to have price stability, and we got to have full employment, maximum employment.
And just quickly, you mentioned the housing market remains kind of weak. With these rate cuts that we've seen, is there a chance we're going to see more affordability in the housing market so more people can maybe enjoy that part of wealth creation? I mean, the average age or median age of a first-time home buyer is now 40 years old. That's the highest on record.
Silver's blasted.
Yeah, so the housing market faces some really significant challenges. And I don't know that, a 25 basis point decline in the federal funds rate is going to make much of a difference for people. Housing supply is low. Many people have very, very low rate mortgages from the pandemic period, and they kept refinancing and caught the really low. So it's made expensive for them to move. And we're a ways away from that changing. Also, we haven't built enough housing in the country for a long time, and so a lot of estimates suggest that we just need more housing of different kinds. So housing is going to be a problem, and really the tools to address it are we can raise and lower interest rates, but we don't really have the tools to address a secular housing shortage, a structural housing shortage.
Chris.
Thanks. Chris Rugaber, Associated Press. You mentioned on inflation, services inflation being low, goods inflation looking like maybe it'll peak. We had the wages report you mentioned today showing moderating wage growth. Where are there inflation risks? It looks like inflation is cooling, in your view. At the same time, you have potentially negative hiring. Why not? Why aren't we hearing more about maybe more cuts in this environment?
Well, I think the risk inflation is pretty clear to see, and that is, we see higher inflation. As I mentioned, most of the inflation over target is from goods, and we estimate, we expect, most of us, that inflation will be a one-time price increase and then come down. We just came off an experience where inflation turned out to be much more persistent than anyone had expected. Is that going to happen now? So that's the risk. The risk is either that tariff inflation just turns out to be more and more persistent, maybe because companies who are now holding back from passing through the tariffs will just keep doing that. So you see that. I think the other possibility is less likely, and that is just that the labor market gets tight or the economy gets tight, and you see just traditional inflation. I don't see that as particularly likely. But so I think, again, all across the committee, people see the picture pretty similarly, but see the risks quite differently. And some people do see the inflation risk, and I wouldn't dismiss that case. I don't dismiss that case, but you've got to make an assessment, and this is the assessment we made.
He was blasting.
Hi, Chair Powell. Neil Irwin with Axios. So this has come up a couple of times today, but to be clear, do you believe that we're experiencing a positive productivity shock, whether from AI or policy factors or whatever? And how much is that driving the higher GDP projection in the SEP?
So yeah, I mean, I never thought I would see a time when we had 5-6 years of 2% productivity growth. This is higher. This is definitely higher, and it was before it could be attributed to AI. I also think if you look at what AI can do, and if you use it in your personal life, as I imagine many of us have, you can see the prospects for productivity. I think it makes people who use it more productive. It may make other people have to find other jobs, though. So it could have productivity implications while also having social and labor market implications that we don't have the tools to deal with. But yes, I think we're definitely seeing higher productivity. I think it's a little quick to be saying it's generative AI, but I don't know. The pandemic may have induced people to do more automation and do more things with computers to replace people, and that raises productivity, output per hour.
Does that imply a higher neutral rate, and therefore the policy might be a little easier than it seems?
All things equal, yes, but all things aren't equal. There are many things pushing in different directions on where the neutral rate would be. But yes, that argument does come up.
Matt Egan.
Thanks, Chair Powell. Matt Egan with CNN. After today, you only have 3 more meetings at the helm of the Fed. Since becoming Fed chair, you've seen multiple trade wars, the pandemic, COVID reopening, period of high inflation. I know your term's not up as chair until May, but I'm wondering if you've given any thought to what you want your legacy to be.
My legacy. My thought is that I really want to turn this job over to whoever replaces me with the economy in really good shape. That's what I want to do. I want inflation to be under control, coming back down to 2%, and I want the labor market to be strong. That's what I want. And all of my efforts are to get to that place. They have been all along, but ultimately, that's what I'm. And it's I don't have time to think about bigger things. I hope many years ahead to worry about that, but there's enough to do.
Relatedly, have you given any more thought, and can you tell us any more about your plans on whether or not you plan to stay on the Fed Board of Governors even after your term as chair expires?
Again, I'm focused on my remaining time as chair. I haven't got anything new on that to tell you.
Go to Mark for the last question.
course it's going to stay up.
Chairman Mark Hamrick with Bankrate. Even while many price levels remain elevated, the reductions in the federal funds rate means that savings rates, or yields to be more precise, have peaked, while key borrowing rates remain elevated. And that's, as we've discussed here, as many Americans struggle with liquidity or emergency savings challenges. Is that just collateral damage or an unintended consequence because your tools are limited in addressing individual or household liquidity constraints, insufficient money in the bank?
I don't know. I wouldn't agree that that's collateral damage of our. I mean, over time, we do what we do in order to create price stability and maximum employment, and those things are hugely valuable to all the people we serve. When we raise rates to bring inflation down, that does work by slowing the economy, but we've moved back our policy back down to where it's certainly not strongly restrictive at this point. I think it's sort of in the range of neutral. So that's what we're trying to do, and I would want people to understand that. I think what people are feeling is the effect of higher prices. There was a global wave, sort of every large economy in the world, sort of every large open economy, market-based economy in the world had a wave of inflation that looked an awful lot like ours. We actually came through better than any other country, substantially better. We had higher growth, we had better labor market, and this is really due to the American economy. We have an extraordinary economy, and people are innovative, they work hard, and so all of us who work in economics jobs are really fortunate to have the U.S. economy. So, thank you very much.
Thank you very much. Guys, ladies, gentlemen, colleagues, we only have 3 more 𝐤𝐴 streams ever. I don't know why. Did anyone have an answer? Why are random people even in the live showing up and saying that he's resigning? It's a resigning speech. What are you talking about? Weird. But we only have 3 more left. 𝐤𝐴, the man, the myth, the legend. Love him, hate him. He's a superstar, baby, and we made him that way. I guess it's our duty to make the next chair also a superstar, and we will. Don't worry. We'll carry that torch on. But certainly an end of an era coming in. We have January, March, April. That's it. We may, never thought this day would really come, but it's here. I love you all for being on this journey with me, and I appreciate you being here. That was about what we expected, let's be real. We called 25 EPS cut. We called not a lot of talk about quantitative easing or tightening. There was a little bit. I don't think he really talked about unwinding. I think overall that was more dovish than I expected. I'm not sure if there was a literal pause announced or not, but I think that's still likely. We did confirm that he is AI. We confirmed this because in his speech he said short-lived. I think he said inflation, short-lived. He has never said lived. He has always said lived. And it's rubbed us a weird way because it's kind of abrasive to hear as a native English speaker. He said lived this time. What? I can't get over it. It's weird. It's very strange. He might be AI. He might be a computer program. He might not be a human. I don't know. It's interesting. I think it was on the dovish side. I don't think it was on the hawkish side. What else we got? 25 BPS cut came and went. Stocks apparently enjoying it. Stocks with a little up day now. They were up at the beginning of the speech. However, now they're up almost an entire %. Still under all-time highs, but they definitely look like they're targeting all-time highs. The dollar lost some strength, and Bitcoin looking pretty good here. I'm not going to lie. In a bigger picture, Bitcoin maybe following the TA, respecting the TA. Looking for that retracement, that bounce that's going to decide our futures for 2026. Are we going to see the dead cat? A rejection? A fall? Bear market? Or perhaps we see something new. I hope so. Perhaps we see something we've never seen before rallying into 2026. I hope so. I have not lost hope or faith in Bitcoin hitting an all-time high before the end of the year. That window is closing quickly. The Fed did not give us any kind of curveball. There was no mix-up. Markets got what they expected, and that's largely bullish, I'll say. Pretty much any other outcome would have been more bearish. What else? What anything key that you guys remember in this? He said data more times in one sentence than I've ever seen him say before, which is bonkers. Absolutely bonkers. Gary G returning in 4 years, I doubt it. 𝐿𝐴 singularity. Yeah, people kept saying he's like resigning. It's his resigning speech. What are you talking about? 𝐿𝐴's going to be here until May of next year. Well, I guess I say May, but technically April will be his last FOMC. I think, yeah, there is no FOMC in May, and then it'll turn over and it'll be the new chair. I don't know why people keep betting on it. I did share that it might have something to do with prediction markets earlier. Prediction markets, we saw high volume and we saw people betting on things that weren't going to happen, and kind of incentivized people to convince others that that wasn't going to happen based on nothing. It's a weird world that we live in, for sure. I appreciate everyone tuning in. This is the last FOMC of 2025, a cursed year. I'm ready for it to be over. I know you are too. If you tuned in, if you were one of the thousands of people who tuned in today, I appreciate you being here and I love you. We will be live again on Friday at the latest, though the way Bitcoin's looking, we might end up live later tonight, maybe tomorrow. Make sure you're subscribed with notifications turned on. You don't want to miss any of our spicy emergency streams. I don't know how, but somehow we have more viewers on X than on YouTube this time. Not nearly the same amount of chatters, but I'm blown away by this. How is this possible? You had 20,000 views on it already on X. The post itself got 54,000. I don't know how that's possible, but that's awesome. Let's go. Not a lot of update. Maybe Nothing Burger was the winner here, but really that comes from a place of us being spoiled. It's not that it was a nothing burger. It's that we got what we expected, and that wasn't exciting. I think that's really it. Ethereum looking good to clear 3,300. Maybe testing as high as 3,700. I still would probably be looking for a back test of 3,300 as support, maybe after 37 is tested. Ethereum looking pretty good. Tether dominance sinking still, hoping that we see a breakdown. I might be misplaced, that hope, but we'll find out in real time. Silver hitting all-time highs during the FOMC. It's pulled back ever so slightly now, but $100, maybe not by end of year. Yeah. But certainly in its future, looking very, very likely. An interesting and unexpected move during this. I'll have to update this, see if it's true. It's no longer true. Probably makes sense. I was going to say gold sold off, though gold has recovered that sell-off and now is trading higher, showing strength in tandem with silver and gold. It just won't quit. Gold is such a superstar right now. Like, wild. Gold is stealing our golden bull run. Higher lows, flat top. Gold, I think, is still aiming potentially even still by the end of this year for 5K. We originally on this channel made a crazy call on gold back last year. When it was at about 2,600, we said that it's looking to go parabolic. It went parabolic. I said double. It hasn't quite doubled, but it's been damn close. Man, I think that there is still a big move. Yes, I think it's for Bitcoin, but really for all markets. I think there is a large volatile event that is coming before the end of the year, and that is not a lot of time. It is currently the 10th. That gives us exactly 3 weeks left in 2025. I know it's been boring, but I think we're going to get a season finale for markets. I hope that you tune in and you share it and you watch it and you enjoy it or you fear it with us at youtube.com/TomCrown. Jump in our Discord, discord.gg/TomCrown. It's free. Check out our exchange partner, BYDFi. No KYC, all kinds of goodies, bonuses, everything you need. In the video description and pinned to the top of the chat. I love you guys. Stay tuned. We very well may be going live again today, and something tells me that we probably are. Bitcoin looking very good for that bounce here. That's all for today. Thank you. Crown out.